Straight into our stock of the day. Thought we'd take a look at Lovisa, the jewellery retailer, seeing a very bullish re-rate coming from Macquarie, with the broker hiking its valuation by 47% from $17 to $25 as the company hopes to target growth in India and China. Now, Macquarie citing the potential 1,400 or more customers in those markets for the move, or 1.4 billion rather, upgrading the stock to outperform from neutral. Checking in on how the shares are faring off the back of the news, and as you can see, it's been a pretty healthy chart for Lovisa over recent times, but that big upgrade from Macquarie. Howard, Lovisa regard as being one of the best retailers in the market, but a very bullish forecast from Macquarie. What do you think of the stock?
Pretty well, and it's growing around the world and opening up more stores in many places. Return on equity, as you'd expect from a retailer, is high. Debt levels are very high, but a lot of that is leases, so that's less worrying debt than if it was bank debt, but still worrying a little bit nonetheless. So it wouldn't pass our filters. The debt levels are far too high. And earnings per share has sort of been growing, but I mean, it's not all that spectacular growth. 2018 and 19 were their two highest earnings per share. Obviously, COVID hasn't helped them. But, you know, the PE ratio is so high for a retailer. It's on a PE ratio for the past year of about 93. Now, wow. Even if one makes a few heroic assumptions, so I looked at it this way this morning. I said, let's assume the earnings would have been double if it hadn't been for COVID. Now, that's a fairly heroic assumption because it would have been by far a record earnings per share this year, if that was the case.
Yeah.
Let's assume in 5 years' time that it's on a PE ratio of 30, which is a very heroic PE ratio for a retailer. Retailers generally are on PE ratios of 20 or less. And let's assume it grows 30% a year every year for the next 5 years. Now, that's again a very heroic assumption. Few companies grow more than 20% a year for the long term. Short term, they sometimes do. And even on that basis, your return over 5 years is fairly miserable at the current share price. So I think it's a terrific business. But, you know, you've been able to buy the same company on a PE ratio of under 20 every year except for the last about 14 or 15 months.
Right.
And now it's on a PE ratio of 93. Yeah. So it would have to come down an enormous amount in price before anybody in Team Invest would be enthused about it.
Yeah. It's that's almost a tech stock multiple, Gary, isn't it?
Yeah. Look, I did look at the forward PEs and stuff there. So I think it's 53 times sort of full year, and then with 43% growth the following year. So probably bigger than Howard's number there. That's still on about 37 times next year's number. Oh. So the PE is pretty high. So pricing and a lot of growth there. Look, it worries me a little bit seeing that upgrade too. So Macquarie was basically probably the lowest. I think they were sort of sitting at 17, which is the lowest of all the majors there.
Right. Yeah.
Suddenly gone to $25, 47% upgrade. So obviously possibly reacting a little bit to being behind the eight ball on the call.
So in other words, you're saying they got it so wrong.
Well, they're on the wrong side of it.
They've now upgraded it to be ahead of the pack.
I'm more worried about the, the cynic in me of this industry is that when you sort of maybe get too aggressive there, you might be looking for a little bit of corporate business as well. Okay. So, I mean, there's only about 36 million cash on the books. So, Lovisa still want to basically, I think, got about 60 stores in the US. So, they made it pretty clear in all the reports they're really looking to ramp up their the growth and so I just worry here that maybe there's
maybe a raise coming.
Or might need some more money to if you want to expedite the growth.
Right.
So that makes me a little nervous here as well. So if the PE is not big enough, that worries me secondary as well. So so if anything, it's probably a sell for me today.
Right.
But look, great business, probably just not a good price here.
Yep. Howard, just following up on your comment on the debt levels of Lovisa, which is probably leases, that's only been a fairly recent change in sort of accounting standards, hasn't it? That a lease becomes debt. So, but a lease for a retailer is sort of good debt, is that? Because you've got to have a lease for your stores, and do you treat it differently in your filters?
A little bit, but I mean, all debt is bad because at some stage you've got to pay that money. And the number of retailers who go broke and because they've got leases that are too expensive for them is enormous. You know, I mean, retailers are businesses that often go under. Now, there are a lot of retailers, there's others that don't go under, but, you know, a lot of retail businesses don't make it. But it's not as bad debt as a bank, because if you owe money to a bank, never mind what the covenants are, if the bank doesn't like something you're doing, they come along and say, give us the money, and you're in trouble. If a landlord says to you, pay your lease, and you can't, well, you do like Solomon Lew has demonstrated, it's so easy to do. You say, well, I won't at the moment. Your shopping centre isn't busy enough. We won't pay our rent. The worst they can do is close that store down and eventually try and sue you, by which time you've solved the whole problem anyway. So it's not as bad debt as owing money to a bank, but all debt, as Warren Buffett and Charlie Munger always say, debt's a 4-letter word.
Okay, all right.
Did you see the update yesterday with the JobKeeper on Lovisa as well? So they've managed to pocket about 8 mil a year the last 2 years, the last two terms are 8 mil, so I haven't paid any back.
Right.
So there's a lot of them releasing these announcements sort of after 5 o'clock, sort of in the quiet when no one's looking, hopefully going unnoticed. But there's a few retailers recently definitely sort of taken a lot of money and not giving much of it back. So
a lot of corporates across different sectors as well. All right, Bendigo Bank